I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan. Here to take you through the rest of this hour as the futures market closes at 5 Eastern, 4 Central. If you're on the platform, Tastytrade on the website, tastylive.com, welcome. Tell us what you think in the chat on YouTube. We had the Apple event today, gentlemen. Dylan, we don't need to teach you Italian. Next generation AirPods will have live active translation in them. Oh, that sounds cool. So much for needing to be autodidacts in the future. We'll just have, those universal translators like in Star Trek. Cool. Either way, though, that's not the big news of the day, Dylan. The big news, of course, Ilya, the job revisions, birth-death model adjustments, an economy that's being overstated, 50 basis points of cuts coming next week. What a world of possibilities we entertain here. But whether or not those cuts come doesn't seem to be bothering the markets, or bonds, or gold, which if those cuts are coming, gold and silver certainly didn't get the message today. We have oil on the move thanks to Israel going after Hamas and Doha. Okay, that's a new wrinkle. Oil prices do come back in as the U.S. denies any involvement. And then the dollar here, quite frankly, firming up a little bit. Euro, pound, even the yen giving up its gains after rumors overnight that the Bank of Japan would hike rates at their next meeting. Volatility stays pinned lower. IVRs are dipping. I think first things first, Ilya. Yesterday on the show, we were talking with Mike Butler. We put on at least I put on the SPX Iron Condor trade, put it on, took it off, made a quick $90. Thanks, Mike Butler, for refilling my gas tank. So the market doesn't clear out the Friday high. It doesn't clear out the Friday low. We seem to be pinned here.
Yeah.
And tomorrow, perhaps, will PPI unpin us?
Maybe. I think very clearly the markets are waiting for that event risk. You see it today. Bonds don't go anywhere. Stocks don't go anywhere. Gold tries to go somewhere and ultimately ends up basically unched on the day. What's interesting, as you were saying, is that the dollar shrugged off what looked like might have tested its ranges, might have tested its bounds. The Swiss franc was the only one that had a meaningful move outside of norm ultimately in the wake of the soft jobs report on Friday. And you end up with a dollar that essentially resets, especially in the euro. The pound to some extent, but especially in the euro and also to a significant extent in the yen from that jobs report, much as stocks have now reset if you look at the S&P from that jobs report. So you have this thing now, it's a bit of a weird month in the sense that the PPI report is coming out first. Usually the CPI report, or at least in recent months it's been the case that the CPI report has come out first. It used to be some years back that the CPI report would always come in second. No more. Now it's kind of a mixed bag. This time the PPI is first, and so obviously that makes it more important because it makes for a more convincing lead-in for CPI, because that's the one that people really want to know. And if you get that one first, PPI kind of falls by the wayside oftentimes. Not this time and not recently, because the PPI data has been where we've seen the tariff inflation start to pass from wholesalers to consumers. Wholesalers were essentially defending consumers up through last month, up through July, that is, the last month of data. And in July, they pointedly stopped doing it. There was a 0.9% jump just in 1 month of PPI. Most of it was margin expansion for wholesalers, and that's them basically saying, you know what, we're going to take our cut back. We're not going to insulate consumers. You pay. And that's obviously the beginnings of the kind of thing the Fed is worried about, stagflation risk. So if this data is hot again, never mind this rate cut. That's going to happen. It is what it is. The markets know about it. It's priced in. The bigger question is what happens after. And the markets are expecting a very dovish Fed next year. Whereas if this data is hot, they're not going to get it. And your audio.
Sorry about that. Rate cuts, no rate cuts. You were talking in overtime about how the only thing that matters is inference. You seem to be locked in on the AI trade still, despite whatever else is going on in the market. What keeps you so focused on this?
Watching the cameras and audio are in a permanent consumption of data of all of us at all times. The AI robots are now mastering the art of inference. So think of like the Netflix algorithm that recommends movies that it thinks you will like and how it actually does a pretty good job, or TikTok doing a good job of jacking you full of ever never-ending set of reels that are to your pleasure and liking. I believe this is that on times a million. And so I think that, we're basically in the process of surrendering any sense of sovereignty of human thought or behavior to the total domination of the fact that we are actually as predictable as rodents on a wheel or ants on a hill. And that the matching of NVIDIA GPUs with Google compute knowledge and Apple listening and camera devices offers a stunning value proposition. For, like, if people thought that you could make a lot of money back in the day, meaning back in the day was probably like a week or two ago or maybe a month ago, but you could make money back in the day using targeting or tagging. Inference makes targeting and tagging look like a general broadcast ad buy in 1977. And so I think that the entire AI super stack, from the hardware through these data companies, from NVIDIA through Meta and Google, represents a value proposition relative to the sale of goods and services that is incomprehensible. Because the issue is there's always a never-ending list of goods and services. Mm-hmm. And then there is a never-ending list of human beings who may have an interest or an appetite to purchase those goods and services. And the only barrier between sales growth in those goods and services is the ability to efficiently match those goods and those services with those individuals at the time that they're looking for that thing or that service. And as the robots and inference takes on total dominance, it will know when you are going to think to yourself, my goodness, I've been wearing 2 shirts for weeks. I need more laundry detergent. And it will immediately know the moment when that thought crosses the mind of who the person is in your household who buys the laundry detergent at a level of efficiency, the likes of which the world has never known. And I think people will delight in it because they'll be like, the robots know what I want before I want it.
Yeah, I mean, Amazon's been doing that for a while, haven't they? I mean, I feel like I get
doing it. Everybody's been doing it. I just think that it's not about doing it. It's about the efficiency that the new technology allows. It's just the next layer of effectiveness of something that we've all been living with for a decade.
No, I noticed the efficiency in something like my Alexa, where it will send me a message every now and again, like, hey, you might be running low on paper towels. Would you like me to reorder you some? And it's like, what are you talking about? And then I go downstairs. It's like, oh, there's only 2 left in the closet. And because I've ordered enough on a certain frequency and a cadence, like, it kind of knows just to ask, which creeps me out.
The way inference works, and that's a great example, just linear, but the inference knows that human beings who allow their cell phone batteries to go to 0 and lose their charge have 100 other behavioral characteristics that have nothing to do with charging your phone. Like, they know that somebody who allows their phone battery to go to 0 also is somebody who's more likely to be delinquent on a credit card payment, also is somebody who's more likely to, I don't even think they have lists. It's the craziest thing I've ever seen. But it's not the linear correlations you would imagine, like, oh, they're counting the number of days since I bought toilet paper. Or they're counting.
Let me plug in my phone then. You're making me self-conscious. I don't want my credit score to drop.
I'm telling you, inference will tell you as a matter of fact that if you are an individual who will allow your phone battery to lose its charge, that indicates 100 different behavioral characteristics that are entirely predictable. And it's doing that at every angle of every touch point of everything. And it's not just like, oh, it knows when I swipe my credit card, or it knows, when my Easy Pass goes through the Tappan Zee Bridge or whatever, the camera and the microphone on your phone are listening to you all the time. Every single thing that you say, every single thing that someone says near you, every location that you occupy, the time that you awake, the apps that you look at, it is horrifying and brilliant and will be the greatest source of money for in advertising base. It's just ad dollars, right? It's the same way it was advertising for William Randolph Hearst when he was a newspaper king, or for NBC in the heyday of the 1980s when they controlled broadcast, or ABC or whatever. Or Meta obviously has been on it for, more than a decade. I just think, or Google, but this next level is going to be at a level the likes of which the world can't even comprehend.
Ilya, that Dylan saying that, it really contextualizes a text message he sent me the other day about the phones and the microphones and watching. He asked me like, hey, can you delete my search history if something happens to me? And I didn't know what it was about, but now I understand his stress.
I mean,
doesn't matter. Even if he deletes his search history, it's already in the memory of the robots. The robots know. Doesn't matter.
Yeah, I mean, I suppose if you have to live as though you are in the Soviet Union and the KGB is in the walls at all times, it would sort of the realization of that might get you to behave this way or that differently. Ultimately, for a simpleton market participant such as myself, all of this is kind of difficult to put a dollar value on, vis-a-vis sort of imagining what it means for price at the margin. I completely see and agree with a lot of what Dylan is saying. I mean, there's no question. I mean, that the phones are listening, that there's an incredible opportunity at the lowest hanging possible fruit with inference, just like there always is with any new technology. The first thing to happen is the easiest commercially viable application. And obviously there is a huge opportunity there in advertising. I mean, just scroll Instagram for 10 minutes. You'll immediately see that the thing is adapting to whatever it was that you were looking at recently, whatever you might have said recently, whatever you might have texted recently, in terms
Whoever
of
sent you a DM.
Yeah, in terms of the things that you've recently interacted with, you immediately see ads for adjacent things. This is not like pie in the sky stuff. But also, just like every technology now and for all time, it will alter human behavior. Human behavior will normalize. The opportunity will close in terms of its outsized potential. Like, all of these things happen and will take X number of decades to play out, whatever. The larger question for me from a trading perspective is, none of this stuff is not in the market as it exists, and all of the really fancy stuff is unknowable in a publicly traded assets kind of sense until it starts to happen. And so the question for me is, which part of this is not, where is the incremental dollar in this story? Let's say over the next 45 days.
Google.
Okay, well, Oracle is out here today with their earnings, plus 21% here, which would be the best day that it's had in this millennium, which I think is a fun way of describing it. Yeah, I think so. Best since 2000. They're saying, the CEO, Safra Katz, says, we expect Oracle Cloud Infrastructure revenue to grow 77% to $18 billion this fiscal year, increase to $32 billion, $73 billion, $114 billion, and $144 billion over the subsequent 4 years. That's a pretty dang strong guidance here. So total revenues are up 12% in dollar terms, 11% in constant currency terms. Their cloud revenues are up 28% in dollar terms. Cloud infrastructure revenues up 55% in dollar terms. Yeah, I mean, this looks really strong. This would be the best performance that they've had this century, this millennia. Not too shabby.
No. But
Dylan.
again, this is that picks and shovels phase that we've been talking about, right? Like, we know this is happening. Take a look at
how can you, because you and Sosnoff talk about getting, how can you and Sosnoff talk about getting short in the face of the supernova?
Because it's priced. This thing that they're reporting is known news. We're just putting numbers on it, and that's why the stock is adjusting. But take a look at what I mean, Chris has it up here. What are NASDAQ futures doing on this? I mean, if you go to a 5-minute chart, is the index noticing? Is this a
kind of?
I mean, it kinda is right.
It's up 40 points, 30 points here after hours. I mean, this is the thing that Larry Ellison said here today. Multi-cloud database revenue from Amazon, Google, and Microsoft grew at the incredible rate of 1,529% in the first quarter. We expect multi-cloud revenue to substantially grow every quarter for several years as we deliver another 37 data centers to our 3 hyperscaler partners for a total of 71. And next month at Oracle AI World, we will introduce a new cloud infrastructure service called the Oracle AI Database that enables our customers to use the large language model of their choice, including Google's Gemini, OpenAI's ChatGPT, xAI's Grok, etc., directly on top of the Oracle database to easily access and analyze all of their existing database data. So if you've been a company effectively trying to build a bespoke AI system for your company internally, and you're an Oracle customer, you can now just have this exist for you as is. Obviously, the market's treating it nice, but this goes back and forth with the question we talked about AI adoption.
Is it treating it nice? Because, I mean, again, look at NASDAQ futures here. They're at the top of their range going back to Friday. They're not even approaching their top from mid-August, where they set their high. Now, if they run, okay, I mean, Oracle, yes, it's responding. We also saw Meta jump to 12, 13%?
Yeah,
on its
13%.
earnings. And what did that do for the Mag?
We haven't done
what did it do
since.
for NASDAQ? Not a thing. So again, my question isn't about the validity of the progress or what it means for the individual companies. I mean, that the price action answers those questions. The markets would tell you if this is nonsense and if this isn't real. They're rallying. They're telling you it is.
Well, I think
what does this mean for the markets and not these individual names? And what the markets are telling us is it means nothing.
Well, could I point out here that reading off these numbers, I haven't mentioned the earnings or revenues relative to expectations. Oracle's EPS was only 147 against an expectation of 148. Revenues were 14.92 billion versus a projection of 15.9. So arguably both missed, and the stock is still up 20% plus after hours.
Well, this is the whole thing.
Because people care about what's coming down the pipeline. They don't care about what's in the rearview mirror if it means sunnier days are ahead.
But again, they only care for the name, for the individual company. It's not going to broader sentiment and hasn't gone to broader sentiment in a month.
Well, that may be changing here, Dylan. I'm looking at this chart, and it kind of looks like it's edging up and out of a consolidation that it's been in over the past few weeks, which is better than you could say for most Septembers when the NASDAQ and the S&P usually take a step back. Perhaps you could opine on this, Dylan. Why isn't this September like it is usually for stocks, where people usually get spooked out? What's with the resiliency in the market this time around, given everything going on in the world, particularly in the United States right now?
Yeah, I mean, there is a lot going on and lots of sort of points of anxiety. You have the tariffs, you have the geopolitical shifting winds and tides and all those things, and you have sort of tremendous amount of uncertainty regarding the number of rate cuts that shall follow the upcoming rate cut. We don't know what's going to happen with inflation. There's all sorts of questions about the labor market. I mean, there's just a tremendous amount of uncertainty everywhere, which should rationally create a much higher level of instability in the financial markets. I just think that you just have this one minor issue of the largest and most significant technological revolution in the history of all humanity, larger than the railroad, larger than electricity, larger than steel beams and skyscrapers and the internet and the telephone,
It would
or
have
the
to be, right?
combustion engine. You're dealing with the artificial intelligence supernova that no one fully comprehends. And as a result, it is powering an incredible upward momentum in all equity values, rationally or irrationally. And it renders any traditional analysis of underlying macroeconomic fundamental information as utterly irrelevant. In fact, a byproduct of the success of artificial intelligence shall be an incredible spike in unemployment and a wide variety of sort of outlier economic data as the entire infrastructure of the labor force is rearranged to eliminate all junior level computer programming, all junior level financial analysis, all junior level communications, all junior level marketing, a tremendous amount of junior level legal work, all as we speak is in the process of evaporating, the consequences for which the world does not yet know. But the short-term reality is that there is a buoyance, an ebullience, an effervescence, if you will, that expresses itself in equity pricing, and as such steamrolls those who are foolish enough to stand in their way with comments about jobs or inflation or tariffs or other things. And that is why this particular September, and I suspect October, shall be some of the best performing months of any September, any October that has ever been witnessed by man or woman at any time.
Oh, Ilya, we're going to hit Bank of America's target.
Interesting then that stocks haven't gone anywhere in a month.
It's a legendary hater.
It's early September, wise guy.
No, but it's, let's say Bank of America is right. We talked about their estimate for where the market will close in next year.
Mm-hmm.
We're talking 9,700, I think their target was.
Looking for 10 grand over here. They should ask this guy, 10 G's.
Well, that would just be unbelievable. You can't give a round number, right? It's like the 17 trillion, 2 on the nose.
Write it down.
It was 20.
Write it down.
Ilya, this all of a sudden is becoming a little bit of a different candle here as we go into the close, because all of a sudden the high for the day, 65.32, we're going to be closing effectively at the high. I see a NASDAQ and an S&P, though, that are still somewhat range bound. So if you're a bear, right, as a bear, where are your tap out levels if this market's about to rev up? That's it. Just keep it to 65.42, and then the NASDAQ 24,068.
Yeah, I mean, obviously support and resistance as such are never a level. They're usually kind of like a squiggly line drawn with a shaky highlighter. But give or take the highs. If you have a convincing break of the highs, then obviously the consolidation has been a correction in time, let us say, rather than a correction in price. The markets have digested. The next leg of the move is upon us. That move will ostensibly have legs if it occurs. In the meantime, the risk reward is unmistakably better being short. There's just no question about it. Vol is incredibly cheap. You have all the reason in the world to see asymmetric opportunity, because if you're short, then you're going to be wrong very fast. If in fact you are wrong, you're within spitting distance of the highs. And you haven't gone anywhere in a month. And in not going anywhere, you got 90%, 91% certainty that you're getting this rate cut. In fact, a little sprinkling of a possibility that you're going to get 50. The markets are convinced we're going to get 3 more cuts next year. Earnings out of these Mag 7 names that Dylan loves so dearly, they've been pretty good. In fact, not a one of them missed expectations. Tesla was the soggiest. It met on EPS guidance, but beat on revenue. Not a one of them missed. Meta essentially took the doors off the hinges with their report. And still, stocks have gone nowhere, but the rate story has only gotten better. Why can't this market rally? It has the good news. What's going on? All the indications, aside from jobs data, seem to suggest, in fact, that the economy is reheating. That economic growth is picking up. That seems to be the story in the ISM numbers, in the S&P Global PMI numbers. What is it that this market hates so much that it can't rally for a month straight? So in my mind, if it does decide, and maybe it's just that it discounted all of the imaginable AI hopium, and now it needs perhaps some confirmation from the Fed that for all the many unknowns that we can't fathom from here, there will be cheap money to make those unknowns digestible. Maybe that's what it is. And that will set the markets off on the next leg higher after this consolidation. It could be. Or it could be that all of the AI hopium is indeed priced in, and the Fed is going to look at this and say, you're not getting all the rate cuts that you think you're getting. And then the cheap money isn't coming. And then everybody has to worry about all of those uncertainties, including uncertainties suddenly around a Supreme Court case that might invalidate most of the tariff architecture that we've spent 5 months attempting to digest. And so then there's, of course, the situation with the Fed and whether it will credibly provide any kind of policy support that anybody can believe in if the fiscal side ends up getting its way and taking over, at least in spirit, if not in fact. And so you have all the architecture you would need for the markets to go, right, okay, we already know all of this pie in the sky AI stuff. In fact, the fact that we're talking about it here means the markets have discounted it ages ago. And so with that in mind, the risk reward is fantastic. So if you're wrong fast, and you flip over and you get long. And if you're right, the opportunity is many times over what the risk is.
I'm not sure if I like it, Chris. I don't know if I like it at all. I'm not sure I like the use of the word hopium. I feel like there's a little bit of sarcasm coming from.
There might be a soupçon of sarcasm.
I feel like listen. He was entitled to the monologue. I took mine. He was allowed his. But I would just like to comment that I felt like there's the use of the word hopium was had a touch of condescension.
Dylan, there's a position sitting here in the follow account that was initiated 100 ES points ago at 64.35 long, purely out of spite against Ilya's antics.
Yes.
Do we keep it on, given his recent diatribe?
Double it up. Double it. Just, every time he says hopium, I want you to double it.
Yeah, I mean, I have the kind of capital allocation for me to go on broken record mode.
Yeah, I mean, I'm out of directionally neutral things in stocks. That was just a one-day thing for this morning. And quite frankly, the way volatility dipped this morning in the market after the revisions to the jobs report, where it kind of just got pinned around 6,500. I was at 80% plus target profit in the SPX short iron condor on the 0 DTE. So having mismanaged the reverse iron fly 0 DTE on Friday, when I was basically trying to get from 85 to 90% max profit on either side and ended up closing out a complete bust, I said, you know what, stick with the mechanics, got what I wanted, get out. And then this market rallied. So the only things that I had on today in the rally were the the call spread in ES and then the MES long position here in the follow account. I'm totally comfortable sticking with them, although this feels kind of trappy if we're going to be forthright as we get ready for CPI on Thursday, because we haven't cleared the NFP high. The NASDAQ hasn't quite gotten, so it feels like we're going to make an attempt, right? The NASDAQ's going to make a drive for 24K. The S&P is going to try to spend some time above 6550. And if we can't hold there through the end of the week, is going into next week's non-farm payrolls report on a little bit of shakier footing. But in terms of the equity market move, right, we've now seen with these revisions, and I think this is the real story here because it seems like we're 40 minutes in. I can't believe we haven't talked about this. How weak was the Biden economy last year? 911,000
weaker than expected.
911,000 fewer jobs in the April 24 to March 25 windows. This does not cover the Trump presidency, but it follows on last year when the initial revisions were 818,000 jobs lower. And then when we ultimately round out into the final form of that report, I believe it was 598,000 with a final revised lower. So between last year's final revision and then this year's ultimate preliminary revision thus far, we're talking about 1.5 million fewer jobs in the final 2 years of the Biden presidency. I think, again, that's really worth contextualizing here. What does that mean in terms of the run rate for inflation during this, run rate for jobs during this window? The prior jobs growth was 147,000 jobs per month based on the data that we had for that window, April 24 to March 25. Now, less than half, only 71,000. Ilya, if we think about all of the releases that we've had over the past year, okay, and you lob 71,000, if you lob off 76,000 jobs per month, which is what we effectively just did, okay, you're not talking about a Federal Reserve that may be considering cutting rates in September. You're talking about a Fed that should have been cutting in March, in June, in July. It should have been cutting
and then
last
some
summer.
of us get guff for questioning the strength of the economy and the likelihood of recession risk. The markets and the economy are, of course, not the same thing. But this is exactly the kind of thing that you get in the anecdotal data, like the PMIs last year, that you don't get in the official data, that keeps the Fed from cutting and that gets the markets going. You need to get a move on here.
Get a move on here, though. We joke tongue-in-cheek over the summer that we're going to get 0 or we're going to get 50. And it feels like last summer deja vu all over again.
Yep.
The only question is whether or not it's a maintenance cut or a recession cut. Given what we've seen today, Ilya, do you think the market's gearing up for a recession cut or a maintenance cut when the Fed cuts next week by whatever degree it does?
I think that will depend very, very strongly on what shows up in the SEP. I think the markets care much more about the SEP than they care about the actual move. I think the move is priced in. The markets are, at this point, sitting at about 60 basis points for the year. So they're a little bit under 50-50 on a third cut. They know that, though, that the 50 basis points that the Fed's been telling them about since December of last year, they know that's coming. There's no controversy here. The question is, what's going to be in the SEP? And I think if what's in the SEP looks scary, it can look scary in two ways. If the Fed goes from seeing 1 cut in June to now seeing like 3, I think that would be scary. I think the markets would look at that and go, oh my God, they missed recession.
Okay, hold on a second. But if we get to 3 for next year,
yeah,
that is going to require...
Markets are already there.
Markets are there, but for the Fed to actually get there themselves, it's going to require 8 members. This comes from Rand Max Neil data. It's going to take 8 members to lower their year-end projections for 2026 to 3%.
Which is why it's not going to happen.
But they could do that over 2 meetings.
Over they could, perhaps. Well, the next update would be in December.
Okay, I'm saying they can do that over 2 meetings in which an SEP is produced. They
Yes,
could signal
they could.
next year that they're
They
like
could.
at 2 to 2.5, and then in December they say that 3 is coming, and so the market says, okay, the Fed's not there yet, but directionally they're moving towards we are, so they get the picture.
And this is exactly what they want to see. I think what the markets want is for the Fed to go from 25 to 50. They want to see that there is movement in the direction of the market's forecast. But the other way that the Fed can spook the bejesus out of everybody is they stay at 25 basis points. And they say, well, actually, have you seen the PPI data? This inflation isn't going anywhere. Have you seen the second quarter GDP data? All of the things that were keeping tariff inflation at bay, the front running of them and the building of inventories, that's already going in reverse in the second quarter's GDP data. Never mind thereafter. The barrier that wholesalers decided to put on their back and insulate consumers, that disinflationary force, that's now spent as of July. So I think the Fed looks at this and goes, well, if we were worried about pass along inflation before, we're doubly concerned about it now because we can actually see it. Before then, it was hypothetical. Now it's in front of our face. Are we going to commit to more rate cuts and encourage the markets to bake it in further? Would that be the thing we want to communicate? No. We want to tell the markets, hey, don't you dare build out inflation expectations. And so with that, they stay at 25 basis points and the markets go, but we want 75. And that's a rug pull.
I don't like his attitude one bit. Don't like it. Don't want to hear about it.
Guys, we have 15 minutes left here. Let's change our focus. I read a really interesting article on The Atlantic yesterday, Dylan, which I thought that would be interesting to discuss here because it's less about the short-term macro and more about this AI revolution. It comes from Annie Lowry. The job market's hell. Young people are using ChatGPT to write their applications. HR is using AI to read them, and no one is getting hired here. She's painting
That's
a paradox, right?
Exhibit A, sir. Exhibit A.
That's fantastic writing, by the way. Just
this AI wrote that article.
Okay, so let me give the background here because
kudos, Skynet.
You may not be able to get the full view, but basically she says on the surface, the U.S. economy looks healthy, 4.3% unemployment rate, wages have been ticking up, corporate profits are higher, wages in real terms, right, outstripping inflation. But when you look at this, hiring is stalled, young people in particular, the college unemployment rate this year or recent graduate unemployment rate is going to tick north of 5%. For context, where it was in pre-pandemic 2019, the unemployment rate for new college graduates was about 3.3%. Okay, so structurally it's a weaker market, and obviously new college graduates have a higher unemployment rate than the broader economy, which still sees a 4.3% unemployment rate. So I don't know. I mean, first off, I'm trying to figure out whether or not this is even, should companies even be using AI in screening, Dylan, like this? How are people going to get around this, though? Because if we are really in a world where young people are using ChatGPT,
there's no more people. It's all robots submitting and robots reading. The whole thing is now been reduced to human beings using AI to draft resumes and proposals that are then sent to other human beings using robots to evaluate those proposals. And I'm being a little bit sarcastic right now, but I really think that we're coming to a place, I believe we are very rapidly going to come to a place where face-to-face human interaction and human dynamics are going to be at an incredible premium, because I actually believe that we're going to see the value of digital or written, that basically non-physical interaction is going to move to a zero value proposition, because even if the resume or the proposal was not written by AI, or if the evaluation or contract award is not made by AI, it's going to be presumed that it is. Because
Welcome
it's
to
going
the dark
be so
side,
prevalent.
sir.
Sorry?
So
Welcome to the dark side, sir.
Elliot,
So
I agree completely.
So I think you're going to see an incredible premium on, I need to sit in the same room with Ilya and talk to him and ask him, how is he going to navigate this chat? How is he going to help me, this company, this organization, this college, this institution, whatever it is, or whoever's on whichever side hiring a contract, awarding a contract, or pitching a contract or a job or whatever. It is, how is this individual going to help this institution solve this problem? And how are they going to use AI to do it?
So I have 5 questions here that I want to talk about and give you guys each a minute to respond as we wrap up the last 10 minutes.
I just believe that I just want to finish. I think young people are in the greatest peril. I just think that all those entry-level jobs, as I mentioned, finance, programming, communications, legal, marketing, are fucked.
Okay, so let's start there, though.
An entry-level job is going to become something else.
Right. So for younger workers facing these longer job searches and fewer stable career paths, how sustainable is the current system that we're dealing with here if this is going to be such a disruptive technology? Are we risking eroding generational trust in markets and capitalism itself if we're pointing to a labor market that no longer functions in service of the broader economy, Dylan?
Yes. Next question.
In the short term, yes. In the long term, no. This is exactly the same thing as what happened to the music industry with the advent of streaming. Eventually, whereas before you had to come see the man about a record contract, and the man would use the incredible resources of a record label and a media company to push things out there. And when streaming occurred, all of a sudden it disrupted that ecosystem tremendously. Outlays on artists fell away. All of a sudden, everything started to get worked down to the lowest common denominator of ringtone nonsense, until individual musicians figured out that you don't need the man, that you can make money as a solo entity, because
SoundCloud,
now
YouTube,
with
Spotify.
technology you have all the ways to market.
But isn't that an economic revolution? Isn't that an entirely new economy?
Of course it is. Of course it is. But but what happened to musicians in that transition is already happening to filmmakers that don't need studios,
for sure.
and will increasingly happen for everyone, where I don't need.
What happens to the millions of young people that sort of paraded through the financial institutions, the big PR firms, the ad agencies?
Oh, there's going to be. So I say in the short term, I think you're absolutely right. But what that transitions into is any individual person doesn't need an entry-level job, because they're able to go from ideation to realization thanks to Skynet. And so the time when you have to go and you need
some hierarchy of an
for
institution.
scale.
I hear it. I got that.
There's a much different gap there. You can get a lot more done as an individual and go fully to market with your services, whatever they are. Because I think you're absolutely right. The premium is not on doing stuff, it's on thinking stuff, because the base of doing stuff Skynet will do for you.
All right, so if this article is an indication of where we're going, if workers, young or old, can't reliably connect with employers in supposedly a healthy economy with a 4.3% unemployment rate, is the labor market still functioning as a credible allocator of opportunity, or is it breaking down something closer to a lottery system, Dylan, or something worse like a neo-Gilded Age where power or proximity to power?
It is an irrelevant piece of data that exists only as a placeholder in the mind of a generation that will die off in the next 20 years, and it will go away. And there'll be different metrics. The labor market as it stands right now, as the way it is presently measured, is relevant only because it is institutionally habituated to my generation and those older than me, and even you guys' generation. But the generation beneath you guys, and certainly the generation beneath them, this measure of the labor market will be there is going to be a compulsion for an entirely new set of economic metrics in order to have any indication of the health of the economy, because the old metrics will prove to be irrelevant.
Well, and you'll probably, as
For the reasons
more and
Ilya
more
just said.
people are able to generate value without being employed by anyone, and likely don't need to be employed by anyone for much longer until what they provide requires the scale of a larger organization where they couldn't get to market by themselves at that point, you're probably going to start to have to measure output, not necessarily in terms of employment as you are in terms of things like consumption, investment, and employment as an input. I mean, GDP is still GDP, but how you get to forecasting GDP probably starts being less about the increase in non-farm payrolls and the unemployment rate, and things like retail sales become very big numbers.
Thinking about the slowdown in the labor market, right? Last year, if we're talking about an economy growing at 70,000 jobs a month, 71,000, 72,000 jobs a month, that's basically frozen.
Yeah.
And that's more or less been the run rate this year so far. It's been very slow, sluggish. Again, no one is getting hired here. Dylan, I can't help but go back to this notion that if the private sector is going to remain in a low higher equilibrium status, and maybe Trump's deportations ultimately turn this around, right? We remove such a substantial supply of labor from the market. It's going to lift wages across the board. It pulls in workers off the sidelines who haven't otherwise, removed themselves from the labor force. Okay. But if the public sector, if the private sector remains in a low hiring equilibrium, should the government, or do you think will the government have to step in through an FDR stylized works progress administration or something more unique like UBI? And I can't keep shaking UBI as this conversation evolves over time.
Yeah, I mean, there's going to have to be institutional solutions, whether those happen at the village and city level, at the church and university and corporate level, at the state and county level, or the federal level. I have no idea. I have incredibly low confidence in I believe the gap between competence and awareness in the government and economic reality of a picture that Ilya portrays, I think, very well. I think Ilya's description is probably, somewhat imprecise, but generally correct, which is logical for any sort of future prognostication. But you're going to have, let's just say it's sort of the continued or even accelerated atomization of the economy, of all these individual single sole proprietorships that are using sort of some creative or some product or
it's like
service.
Adam Smith 2.0. Yeah. It's the Wealth of Nations 2.0.
And so how is that? The transition, you're on the verge of one of the most powerful creative renaissances. I don't know if renaissances is a word. You're on the verge.
I like it and I'll take it.
On one of the most powerful creative renaissance in the history of mankind, and also maybe one of the greatest human catastrophes of lost potential because of the inability to help people adapt.
We hopefully have learned something from globalization, which was this level of transformative good. And I agree. The likelihood is we haven't learned.
When I say back in the day, and I joke and say back in the day 2 weeks ago, I'm not really joking. The rate of change is so much higher than the human ability to adapt. And in the free market, among the relatively highly engaged, highly read, highly active professional class, let's say, which is sort of the most adapted and the most resource independent and the most connected. And they're all behind. Everybody's behind. And so, and if the leading edge of the most adaptable layer of the economy is behind, that means every other layer, whether it's older people, younger people, whatever the layer is less. And there's no layer that's more behind than the government, who's sitting in a delusional insanity of some institutional structure that has them completely detached from the reality of generations of 22-year-olds for whom millions of jobs are evaporating by the day.
I guess the question that I have isn't that any of those things are incorrect, because I think they are absolutely correct. I think the question is, when has it ever been otherwise? When you get a transformational thing like this,
the rate of change, just the rate of change. The rate of change.
Well, and you'd expect it to accumulate, right? You'd expect the rate of change to accumulate because each revolution builds upon itself, right? We couldn't have invented telecom.
We weren't ready for the horse and buggy to the car. We were, I mean, and that took, this rate of change is by the day. It's nuts.
All right, well, we will get back to arguing about the rate of change around horses and buggies tomorrow, because overtime is out of time. We'll be back same time, same place, 4 p.m. Eastern, 3 Central, right after last call. Interesting conversation here, guys, today.
I want to do a new podcast, 2 Dirty Shirts.
I have no idea to which you're referring. For Ilya Spivak in San Francisco, Dylan Radigan in Milan, I've been Chris 2 Shirts Vecchio in New York. After this, a brief break. More Tasty Live coming at you. Ilya Spivak with Macro Money up next.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tastytrade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tastytrade. Download today.
Tastytrade has crypto, and you can trade with 0 commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto. We got it. We get it.
The future of trading is here. Join Mike and his whiteboard, plus the Tastylive crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
I started trading around 2018, soon as I got out of college. Stumbled upon a couple of different YouTube videos and learned that way. Truth or Skepticism with Dylan Radigan was actually kind of what really caught me in the early stages, because Dylan was sort of the skeptic, and like I was a skeptic as well. And Tom was able to sort of convince him, and that was kind of my favorite show from the beginning. The fundamental principle that present fear of future uncertainty is fundamentally overpriced. In other words, volatility and selling volatility is the key to getting a statistical advantage in financial markets, is the biggest takeaway. And that's kind of just the overarching principle I follow.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tastytrade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tastytrade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Calling all traders. Are you using Tastylive mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, Tastylive has shared the most inspiring stories of traders teaching themselves a new skill using probabilities and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you would like the chance to share your trading journey and inspire others.
I think I've always been interested in finance. I have a degree in management and I took a lot of heavy finance classes, and I've always loved it, but I've always done passive investing. And so as I went through life, I decided that I needed to have a bit more control over my finances. I started to dabble in the options world when I opened up a brokerage account in probably 4 different companies, and none of them worked really well in terms of education until I got to Tasty. You know, and Tasty Live in particular, because of the educational background that they tie in every single day on how to learn how to trade options. It started with the Where Do I Start series. It's outstanding. Tasty Bites, market measures, from theory to practice. I don't think there's a show that I don't like, to be honest. You know, that education piece is highly important. I found that Tasty offered that.
Look who's back testing. Tastytrade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tastytrade.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
Got trader's block? We've got the cure. Get data-driven trade ideas with Cherry Picks, our weekly newsletter that gives you insights into the market. Sign up at tastylive.com/newsletters.
The markets mark time on Wall Street today, although there is a little bit of positive drift as we get ready for U.S. inflation data. The biggest piece of event risk this week, and ostensibly the last thing the markets need to see before they get hit over the head with a Fed policy announcement next week that they have been hoping and praying will restart rate cuts. What's coming up first? We're going to break it all down here on this first episode of our 2-day inflation series. This is Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live. And we'll begin with a conversation about the Producer Price Index, or PPI. That's the first part of this story this week. And we'll start off there, taking a look at, first of all, how the markets are setting up before the data, what the data might do, and why the markets are likely to care about it. And then how I, at least, am going to stay positioned in the markets for the data and what I'm looking to see with those trades that I have on. So let's start with what the markets did today. And of course, I took this snapshot a little bit through the post-close jostling and finalizing in the futures market. So don't hold me to the absolute second decimal spot for all of this. But this gives you a sense for what the markets did today. Some narrow gains for the S&P and the NASDAQ, relatively quiet overall. We get a move higher in yield, so bonds take a step back, but not a significant one. The explosive gains we saw coming out of last week still very much the dominant trajectory. Crude oil wiggles up a little bit, up 0.67%. That may or may not have anything to do with another round of shenanigans in the Middle East. There was, of course, an Israeli strike on Hamas leadership in Doha, Qatar. So it's certainly something to keep an eye on here. But at the overall sort of level, crude oil is relatively little changed and still, for the most part, stuck at the midpoint of a range that it's occupied since at least, it would seem, the beginning of the year. The top of the range somewhere in the vicinity of 74. And that's if you look at the extreme high, and the sort of upper 72, 73 area if you look at the closes. And on the downside, around 54. And the midpoint of that range, the place where things have increasingly anchored around, seems to be somewhere around 62 to 63. And we've been stuck with very little movement around that level, basically now, as a sort of oscillation point since, let's call it, the second half of April. It was first a kind of barrier on the upside, then we broke higher, and now it's a barrier on the downside, and we continue to oscillate within very little distance of that center line, and let's call it 54 to 74, the outer bounds. So yes, crude oil wiggled higher. No, it didn't really do anything particularly convincing or set any kind of a meaningful path in a clear direction. Gold down a little bit after hitting a record high, off about 0.2%. So it looks like the very spirited momentum we've seen is cooling a little, at least in front of the data that's upcoming. And the U.S. dollar managing a relatively spirited recovery here, up almost 0.5% against the euro, and flat against the yen, having been down significantly overnight. Bitcoin down 0.77%. If we look at how all of this filters into the performance for the week, we can see here that there's a sort of recovery, at least in some parts of the architecture here relative to last week. We can see, of course, last week a significant decline in yields. Bonds went higher. Now we can see yields are correcting a little bit in the opposite direction as the markets digest. We can see gold is up on the week, so momentum continues there after what we saw last week. The dollar is a little bit better here, it seems, on the whole. So euro is a little bit lower, yen is a little bit lower. For the yen, this is continuation. For the euro, this is a little bit of a step back amid its attempt to recover, and stocks are seemingly finding a little bit more momentum as they correct, but as ever, we are stuck in the same range where we've been basically since mid-August, when that month's CPI data release wave gave us what we are now angling for. Next month's rate, or this month's, next week's, I should say, rate cut. So, as the markets wait, this is what they're waiting for. And the first episode here, as we say, is the producer price index, this. And then we're going to get the headline consumer inflation data on Thursday. So what is it that we're expecting here? We can see there was a massive surge in PPI in July, 0.9%. We're looking for a little bit of a cool down there. The core seen at a little bit of a lower level from 3.7 down to 3.5, but the headline seen holding this 5-month high that it set in July at 3.3%. And here's July's data. You can see the 0.9% surge. It ends up being the largest jump in close to 3 years here. And that, of course, tells us first and foremost that whereas at the beginning of the year, there was some concern around the tariffs, but companies were not prepared to make that concern the problem for consumers because, of course, they didn't want to destroy demand until they saw what the architecture of policy would really look like. As of July, they stopped eating the tariff costs in margins and started to pass it on. Here's the year-on-year number, and here's that 5-month high that we're expected to hold at 3.3%. In July, that was the highest since February, and we're expected to hold this level. Going back to the month-on-month readings, you can see here is the overall margins data within July's release, and you can see here a sharp rise in margins. This final demand trade services component measures where the margins for wholesalers are, and you can see here they've expanded here rapidly. So you can see that they're increasing their prices as input costs change. If you go earlier in the supply chain, this is intermediate demand, whereas this is final demand. So this is the wholesalers that are closest to retail. This is the beginning of the supply chain and where tariff costs occur initially. You can see here there was a massive decline in margins because businesses basically said, we are going to take these costs upon ourselves and we're not going to pass them down to even wholesalers later in the supply chain, never mind to consumers. Now you can see there is a clear change. And while at the beginning of the year there was this attempt to insulate from tariffs, it looks like that's run out of road now. Moreover, at the same time, the GDP data for the second quarter tells us that the other major thing keeping consumers insulated from tariff inflation is also falling away. So in the first quarter, you can see here, there was a massive rise in imports. And since imports are something you subtract from overall GDP, GDP is consumption plus government spending plus investment plus net exports. Net exports is exports minus imports. So imports is something that you take away from GDP. So you can see that the fact that we have a big down bar here tells you there was a massive increase in imports, which ended up being a downdraft on GDP and gave us a negative reading in the first quarter. That was companies attempting to front run these tariffs. You can see that all of that ended up going into inventory. So there was a giant jump here, a jump like we haven't seen in a very long time here, clearly, in inventories, because all of these imports didn't go to service immediate demand. They went to stockpiling so that companies could sell things at the pre-tariff rates longer. Well, look at the second quarter, and all of a sudden you see imports are a big up bar. That means they fell hard. Meanwhile, inventories come down. And exports, as you can see, continue to be essentially a non-factor. The fact that you have these imports collapsing here tells you companies are not restocking these inventories. They're spending them down. And so you're running out inherently of the supply of pre-tariff goods. That's another thing that was keeping consumers somewhat insulated, because there were these inventories at the lower costs, and those inventories are being pulled down already in the second quarter. Never mind what's already occurring in the third. So the concern here clearly is that as companies are passing on these costs, And as they run out of inventory to insulate consumers from these costs, you're going to get more inflation, and exactly the kind of thing that the Fed is concerned about. Weak jobs and inflation at the same time. And of course, we've heard time and time again from the Fed that yes, they're beginning to become increasingly concerned about the labor market, but also that they are not going to allow these tariffs to go from a one-off tariff shock to inflation to lasting inflation expectation gains. And so this, of course, is precisely the kind of stage setting that is critical for next week's Fed policy announcement. Now, that's not because a rate cut might get taken off the table. That much seems almost certainly not a viable possibility. We can see the likelihood of at least a 25 basis point cut at next week's meeting is now north of 90% and approaching 92%. And the edge case here isn't that rates will stay on hold, but that the Fed will actually cut by 50 basis points. The likelihood of that, 8.2%. The bigger issue is what happens thereafter. So we've pointed out before, the markets are betting on a lot more easing next year than the Fed has allowed for. So the market sees 77 basis points in rate cuts next year, whereas the Fed, in its latest forecasting, sees only 25 basis points. You can see here the move from 3.9 to 3.6 is a change of 0.3 or a rounded off 0.25. So the major issue here is that the markets and the Fed are at a meaningful disconnect for next year. And if this PPI data is going to give us more of this and more of this, well, then the expectation will be that consumer prices will go higher too. And it, of course, is helpful in that sense. It makes PPI that much more important this time that it comes before the CPI release. Whereas, for example, last month, CPI came first. And so here, the information that we see in the leading survey data becomes all the more pertinent. We can see here the spirited rise in the price index from the ISM report on services here is telling us just about what we would expect to see. There is about a 2-month lag between this and the major measures of consumer inflation, CPI and PCE. So we can see here, once we lag them 2 months, these things start to line up, and we can see that what seems to be foretold here coming up is an inflationary surge. And that will be exactly the kind of thing that you'd expect to see as tariff costs start to actually arrive for consumers after having been delayed by this eating of the margins for wholesalers, and of course by this front running of the tariffs and inventory build out. What does that mean from a practical trading perspective, and how do you position, or how at least am I positioned for this? Well, you can see here, as we've discussed before, the relationship between Fed policy expectations and stock markets. And it's not difficult to see what's going on here with the naked eye. You can see at the beginning of the year, right around February or so, where the markets start to see business confidence falling off, consumer confidence falling off around the rollout of the first batch of tariffs. You can see that stocks don't like it, and there's clearly a sense that what this will mean is something negative for the business cycle, because there is a shift significantly lower on policy expectations. And as a matter of fact, we end up by the bottom here in early April at 137 basis points in rate cuts being baked in, which, shock of shocks, right around where we are now. What's interesting, though, is that these things move in tandem until they don't. This, of course, is that Liberation Day shock, and ultimately a sentiment recovery. Because what happens is the president steps back once the markets hit a level of panic, and there's a 90-day pause, and there's a sense that the White House is, in fact, responsive to some degree of market discipline. But consider what then occurs. As sentiment recovers, there is a clawing back of some monetary stimulus, but it runs out of road right around here. That lines up with stocks recovering to here, which lines up very nicely with where the shock began in the first place, right there. And then when we look at what then occurs in markets, we then see this outlook become increasingly more dovish, just not for this year, for 2025, where things at this point anchor to where they started, back here. So the growth scare is fully reset. Here's where the growth scare is. Here's where the policy baseline is, down about 50 basis points. Everything resets. Stocks reset. Expectations for this year for the Fed reset. We end up right around where we were before. But what the markets then do is they start to bake in tons and tons of easing for 2026. And the Fed has not endorsed it. But the markets clearly think it's coming. Not surprisingly, that has been a very convincing lift on equities, which of course one might expect were one to look at an expansive, speculative easing cycle that the Fed is yet to make official, leaving, needless to say, room for that speculation to occur. Now, maybe the dollar has already sniffed out that we are unlikely to get quite so much easing, because we can see that the dollar stopped falling as early as the beginning of July and hasn't made a new low since, even as expectations have become more dovish. So perhaps the dollar reasoned that we're already at the place beyond which we will not go. And perhaps the dollar already found this out as recently as 2 months ago. And this is why it stopped falling, having fallen very clearly in line with this dovish shift in expectations. And so perhaps what we're setting up for, if in fact we're going to see something like this, is the markets having to work this back rather than the Fed having to mark this up. And so, needless to say, that puts all of what we saw here in danger. If in fact a significant portion of it owes to this dovish shift in expectations, which it most certainly seems to. So with that in mind, if the PPI data surprises on the upside here, and the pass-through of tariff costs starts to mount, well, then the expectation for the rate cut next week doesn't change. But the likelihood that the Fed goes the market's way in endorsing all of this starts to fall away. And perhaps so do stock markets. So from a positioning perspective here, I am still long the US dollar. This is short Aussie, short pound, short euro, short the Canadian dollar. And thankfully, that went a little bit more so my way at the start of the week here after that post-jobs data dollar pullback. I am likewise long gold because I think its move has been somewhat more linked with uncertainty and less with specific Fed policy outcomes, which is why I think it can hold up reasonably well here, even as the Fed outlook is revised. But I am short Bitcoin through IBIT, the ETF, essentially looking for a risk-off sort of outcome from here. And of course, that's likewise reflected in these put verticals in the Qs or NASDAQ and SPY, S&P 500, and still long at the long end of the yield curve essentially expecting those rate cuts that the markets want so badly to get pushed further out in time and to keep yields at the long end capped, even as perhaps there is a dilution of dovish sentiment at the front end. With that, we have macro money for today. As ever, we are here Monday through Thursday, right after Overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm likewise writing for the News and Insights portion of tastylive.com, commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow for episode 2, CPI. Happy trading.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tastytrade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tastytrade. Download today.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tastytrade. So spread the word and earn rewards. Terms and conditions apply.
Global markets never sleep. Explore them with Forex, now available on Tastytrade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on Tastytrade.
He gets to break as many computer mice as he wants. He can just smash as many as he wants on the table.
If you had to swap jobs with anybody in this office, who would it be and why?
I would like to swap roles with Vanetta for a day, just so I can, talk smack about Tony and Tom for like a full hour in the morning. That would feel kind of nice. Just like a roast to start my day off.
Oh, God. That's a good question, actually. For a day? Forever?
Ever.
Forever?
Ever.
Oh, no. I mean, Tom has a hard job. He's got to wake up really early. But he gets the privilege that he gets. He gets to break as many computer mice as he wants. He can just smash as many as he wants on the table. He can pretty much yell at anybody. He gets first dibs at the lunch line. I think I would, maybe Tom, but I probably wouldn't last very long, yeah.
Probably Dylan Radigan, because he lives in Italy. And I live here in Chicago, so yeah.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tastytrade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tastytrade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
This is Breadwinner Trivia here at Tasty Live. I'm here with Nick Batista. We're going to present him 4 questions. If he gets all 4 correct, I have to make him a peanut butter and jelly sandwich. Let's dive right into it.
And I'm hungry. I want 2 of those.
Which commodity is often considered to be a safe haven asset?
Gold.
Gold is the correct answer.
The shiny rocks, the boomer shiny rocks.
What does the Sharpe ratio measure?
Return relative to risk.
That is correct. What is a credit default swap?
It's a credit that originates somewhere else, and it's traded for different amounts across many different parties.
That is correct. That's not gonna exactly match what they have on screen here.
No, come on. I'm not the smartest guy here.
For all the marbles, for the PB&J, what is the national animal of Scotland?
It's the Highland cow.
It is a unicorn.
What? That's a trick question. I hope nobody heard that, because I want to see a peanut butter and jelly sandwich get made.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
So why are we all doing all the things that we do inside of the active trading space? Simple. To make money and generate returns. Well, inside of the Tasty universe, there are essentially 5 keys to making those returns. And in this crash course, we're going to break down all the details of each one of those keys. So I'll see you inside.
All right, so the X date on a stock, what does that mean?
The X date for a stock refers to the X dividend date, which refers to the dividend of that stock. So if you have a short in the money call and the extrinsic value is less than the implied dividend, then you would be at heightened assignment risk. So the X dividend date is something you want to make sure that you are aware of so that you can either roll or close that position to avoid that extra assignment risk.
What does it mean when you hear the term pin risk?
So pin risk refers to options that are usually on a round number and the risk of a pin at the end of the day or the end of the expiration for that underlying. So this typically is applied to SPX or very liquid underlyings that have monthly or weekly expirations where the stock price or the ETF price or the index price is right at an even number where a lot of volume and open interest is.
We built Tastytrade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tastytrade.
Mike, what does it mean to be assigned?
When you are assigned, you are ultimately short an option. So rolling a position, defending a position, and instead of just closing it for less than loss that you're seeing, or maybe a $100 loss, $50 loss, a green scratch is when you close it for maybe a 5-cent winner, 10-cent winner, 15-cent winner. Just the ability to see that green number on your screen and get out in a profitable way as opposed to a loss.
What is going on, everybody, and welcome back to Risk and Reward. Today is Tuesday, just before some PPI announcements, some CPI announcements later this week. I mean, we even had the Apple release today. But before we get into all that, Gus, my brother, how we doing?
Oh man, well, doing good as always. I am reporting to you live from my apartment, a short way from our studio right now, as I unfortunately have COVID. This is something that has just started today, but and I can't prove it, but I think Errol poisoned me because he likes my side of the desk in that studio better. So I'm pretty sure that Errol had some kind of hand in this.
I've been caught. I'm not gonna lie. Whenever I did hop on here after I was done speaking, I looked over to see if you were right there, and I was like, oh. Not even you said that already. Just already used to being face to face. But hope you're feeling better here soon, brother. But we're almost midday into the week, so we're almost there.
Yeah, we're getting through, and this Apple event gives us plenty to talk about today. Something of a somewhere between a nothing burger and a something burger. I don't know exactly where to place it on that spectrum, but I'm excited to get into it and talk some Apple.
I mean, I guess I'd put it into a little bit of a nothing burger today. What's going on, everybody else? Big deal. Data trader.
Well,
Bob Solid,
it's almost
everybody.
like we have to start moving the goalposts for what is a nothing burger for Apple, because I mean I've gone on record before, and I know that you share the same sentiment, saying that Apple really has stagnated. I feel like in terms of their innovation, this is not the Apple that we knew in the 90s and 2000s that was constantly doing something groundbreaking. But at the same time, I mean, in fairness to them, it's not like anybody has come and taken their market share. It's not like, you know, I mean, they still are doing new things. They continue to update things. It's just we're kind of in a awkward spot. I don't know how they could innovate. It's why they've been great for so long, is because they can innovate in ways that I don't know how. But yeah, every time we do all this build up and run up to one of these events, and then they just say the phone is thinner and has more storage and the camera is better, it's kind of underwhelming.
It kind of feels like Apple, because I don't want to say it was disappointing. Like if I were to take the same perspective into every single Apple event, I'd probably be disappointed. Sometimes I think I'm a little bit more surprised, and I won't give away too much. We'll just go ahead and get into the slides here. The Apple hype continues. If you're not familiar, the Apple conference was today, where they released the new iPhone, some of the features for the new iPhone, and some of their plans moving forward. And they did that today, and today we're going to touch on some of the details as to what we can look forward to for Apple. So I know a lot of us are in the Apple ecosystem, but if you did watch today, I don't know if there was anything that stood out to you, but the main thing that stood out to me right off the bat, and we'll get into the details here, is no mention of AI. If I had to guess, there would have been a mention of AI, I probably would have. Apple seems really conservative when it comes to new ideas. I know even them stepping into the Vision Pro was like, yo, Apple, that's kind of like not a very solid floor you're stepping on there. But I was really surprised they didn't get into the AI part of things with Apple and what they might be doing over there. So before we get into the details, was there anything that you were hoping for them to touch on as a consumer, or would have been interested to hear from them, at least?
I mean, yeah, I think it's AI, and it's such a funny niche little thing, but man, it's Siri. We have got to improve Siri. I cannot believe how terrible Siri still is, how incapable she still is of very basic tasks, simple questions. And I cannot believe that we do not have an AI integration into Siri yet. I don't even need ChatGPT, man. Give me Claude.
No, keep going.
Give me Gemini. You know, put whatever you want in there. Partner with whoever you want. I guess if Google partnered with Apple these days, they'd pull out an antitrust suit on them. But it's just, yeah, I don't understand how Siri hasn't caught up. And this is such a small, little tiny hill to die on, but I will die on it. I need to be able to just ask my phone questions. I can't feel like I'm living in the future until I can say, Jarvis, tell me this. And then it happens. You know, it doesn't work.
Yeah. I'm seeing here.
I'm excited for the new AirPods, though.
I'm very excited with the AirPods. The AirPods is probably one of Apple's, I think, the best product they've ever made. Not only that, I think they've dominated that niche. I have to give it a grain of salt. I haven't used other wireless headphones, so I bet there's some amazing ones out there. But for the AirPods, at least, I mean, I don't think it's a coincidence. That alone is like $1 billion market cap for Apple for a single product line.
I have used some other wireless headphones, and there's certainly ones that can hang, namely the Bose, I don't know exactly what they're called, but the Bose AirPod equivalent product are very good, but they just aren't quite there. The AirPods, I mean, I have no understanding of how they managed to create that type of noise cancellation with that small of a product. I mean, it is really nutty. If you haven't used a pair of AirPod Pro 2s before, I mean, it's very, very interesting, and they are very robust. They have the conversation detection thing so that you don't hear anything going on around you, but if someone walks up and starts talking right to you, they'll turn your volume down and take off the noise cancellation so you can hear that person. It's very interesting, and what I'm most excited about with the new ones that are coming is that I'm seeing that they have heartbeat sensors in them, which is interesting to me.
That is, so it's gonna try and get your pulse from the AirPods, is what it's gonna.
Which is interesting to me because I would kind of like to move away from my Apple Watch. I don't know if I would get a new one. I may continue wearing it, but I don't really think I get a particular ton of utility out of it. It's nice being able to check texts, you know, with just a glance at my wrist, and it's nice for workouts. And the main reason that I've continued to keep it and use it as much as I do is for when I lift. They've made a good system with these rings, man. I really want to close my rings every day, and so that's kind of my only application for it now. But now, if we can do all of that through my AirPods in my ears and me tracking my heart rate and my workout and doing all those things that way, I might be able to move on from the watch, which would be cool. I could stop looking like a spy kid and get a real watch like a man.
All right, Ben 10. No, but with last question before we shift gears here. With the Apple Watch, one thing I never liked was being in the gym or doing something athletic, especially lifting weights with the Apple Watch on my wrist as well. Is that kind of what you're referring to?
No, I don't really mind its presence on my wrist. I think it doesn't, I mean, weird first thing to go to, but it doesn't ever make sense in a fashion context. And then beyond that, I just don't get a ton of utility out of it. I mean, I was sitting there in the gym the other day actually going to start my workout, and I had a moment where I scrolled through all the apps on my watch, and I was like, I haven't even used 98% of my phone apps on my watch. Like, I just don't get that much utility out of it. It is, and like I said, it is nice to just be able to check a text without pulling your phone out of your pocket. Watch 5 vibrates. Check that. Do I need to respond right now or
a
not?
little haptic touch, convenient.
Yeah,
We'll give it
and
that.
and I'll tell you what too. That has a lot of utility if you're like with people or like in some kind of situation where it may be inappropriate to check your phone. Like weird one to pull out, but church. I stay informed. I stay informed while I'm in church because my watch has stuff popping up on it, which maybe that's not something I should be bragging about. Perhaps I should turn everything.
No, this
on
is
airplane
confessions.
mode,
Go
but-
ahead, brother. Yeah. No. I did just see G-Shock being mentioned, and I just got a shout out Laid Back Trader because I mean, if you're from the G-Shock era, you're just a real one, and that's all I got to say about that. That was the Rollies back in the day, the G-Shock. So
G-Shocks were fire. G-Shock still has some nice watches now.
G-Shocks are coming back around.
People like their G-Shocks.
They're coming back around.
G-Shock, I respect it. I think you could probably run over that thing with a semi-truck.
You know what?
With an Apple Watch with a semi-truck, it wouldn't survive.
You know what kind of vibe G-Shocks give me? They kind of that and Richard Millie's. So either Richard Millie's give Ben 10 vibes or the other way around. But Richard Millie's always just seemed like such a toy watch kind of to me, and G-Shock's just always popped. Not that I have a Richard Millie and could like give personal experience as to my experience with one, but just based off my perception. That's what it is.
Yeah, in my experience, it's definitely much closer to a Richard Mille than it is a Rolex or an Audemars. You know, that's just in my collection.
Yeah, it's like that's why I didn't like it. That's why I went with the G-Shock instead of the Richard Mille or the Rolex.
Yeah, it's like why would I pay all this money for a Richard Mille? Maybe when I was a boy, but since I've grown, I've come to realize it's best not to spend your money on these frivolous things.
Yeah, exactly. Got to make the smart decisions here because we gotta be able to buy shares like Apple. But I don't know if you've seen, Speed was actually over here in Chicago the other day. And I bring that up because I don't know if the Wall Street of Einstein, you know who I'm talking about, the guy with the hair, Wall Street of Einstein. I'd seen a clip of him talking to Speed, talking about how, if you would have, bought shares of Apple instead of buying the new iPhone after X amount of years, you would have ended up with X amount. And I actually thought that was pretty cool. Just a sidebar before we get into the info here. I thought that was kind of cool because obviously he's trying to put people on that are watching his stream, which is a lot of young individuals on Speed stream.
Yeah. I hope that he has
Apple.
an excellent financial management team around him. I hope whoever he has managing his money is trustworthy.
Yeah.
Because there's a lot of it, and it would be very easy to flip his net worth from starting with an M to starting with a B if he plays his cards right over the next 20 years.
Oh, you talking Speed?
Yes.
Oh,
yes.
yeah. I mean, if we have some time at the end, we can touch on that. But I mean, just the ruckus Speed was calling, just pulling up to Chicago. Everyone just like, I just can't. I've never seen somebody have so much pull like Speed, unless it was like the A-list celebrities, like 15 years.
It is
different
very
vibe.
interesting, the ability that these streamers have to pull people like more than many A-list celebrities.
Right.
I mean, just about any NBA player not named LeBron James, and they go walking down the street, they are not going to pull the kind of crowd that Speed is pulling everywhere he goes. In China, in Thailand, you name it, he's doing this everywhere. It's pretty remarkable.
That's really valid. And when you brought that up, someone said the other day, a lot of professional athletes wouldn't be recognized if it wasn't like the star player on their team or whatever the case was. And I was like, I didn't even realize how many professional athletes that are in the NBA or in the NFL that I don't actually know by first or last name.
Oh yeah, I was at the casino one time here in Chicago playing roulette, and there was a couple of athletic-looking guys next to me, but I didn't think a thing of it. And then finally, like 2 hours in, I turned to these guys and I'm like, "So what do you guys do for work?" They're like, "Oh, we're on the Patriots." I was like, "Oh, word, that's fire."
And that's just how it is sometimes. I have a very similar story to a guy that was playing with the Bucks. He just sweats, slides. I was like, you look like an athlete and look like you could eat me. I was like, what do you do? He said, I play football. High school down there? No, Patriots. I'm like, Patriots, the Bucks. Very similar story.
It's interesting, and I mean, it's like Michael Jackson level stuff. I mean, if you guys watching right now think that I'm crazy or like being dramatic here, go search Speed in streets of China or pick literally any country, and he's probably been there and probably done this there. It is nuts. I mean, he's pulling like shutting down city centers because there's 10,000 people on the street. It's nuts.
I mean, I thought it was wild when he had went over to China. Some plane thing.
And it's really interesting too because these streamers have such a way of like working their way into culture. Like I have never watched 1 second of a Speed stream, an Aiden Ross stream, a Kai Cenat stream, but I am still incredibly aware of what they are all doing all the time. Like not even by choice. I don't follow fan accounts. I don't try to keep up. It just comes to you. These guys are like it's very interesting.
Can't get away. There's a little bit of our generation, a little bit of our culture we touched on there. We can go ahead and jump over to the platform here. I know we had some of the details with Apple there. I wasn't trading Apple this week. I know we had a couple guys put on some zebras to the downside on Apple, so I know that's doing really well for them at least. there was a pop right ahead of the announcement, and then when they started talking about a lot of the details on the iPhone 17 itself, other products they might be coming out with and future plans, then we kind of got like a sell the news kind of event. Were you watching this live time, or you kind of just had it on the side?
I was watching the share price, yes. I was not watching the Apple presentation, but yeah, and I don't know when we're going to stop doing this with Apple. I mean, it ties back to kind of what I was saying at the beginning of this, that I feel like we need to move the goalposts for what is and is not a slam dunk for Apple, because they're not, I mean, it's like we go into every single Apple event with the mentality that they're going to release a new product, like something we have not ever seen before, the way that it was in like 2000 through 2012 when they're a computer company and suddenly they're like, look at this phone. This is the most revolutionary thing you've ever seen.
And you mean this iPod
in the middle of those two?
Oh, yeah, you're right. The iPhone first and iPod.
Yeah, they're ripping those things. So it's like I feel like we can't be expecting that level of innovation, but the market continues to project as though that is kind of what we're expecting, and it's interesting.
You know what kind of same vibe or same type of evolution, I guess, for lack of a better phrase, that I seen play out same way in like Call of Duty. It's the same behaviors I've experienced in myself, at least. It's like every year growing up as a kid, since maybe I was like 9 or 10, waiting for the new Call of Duty to drop every single October, every single November was like the coolest thing in the world. You go out to GameStop, you'd wait in the line. Sometimes it's really cold, but they would release a limited amount of video games at that location at midnight. So it was like a thing in the Call of Duty community to go line up at your local GameStop to wait till sometimes 11, they might open the doors because Eastern time, if you're in Colorado, they're gonna open the doors a little bit early for you. So some people don't get the game and hop on the servers before you. All those kind of things. It was like a tradition for the community.
Yeah, absolutely. That's one of the regrets of my life that I've never been to a Call of Duty midnight release. I was just too young when that was a thing that you did. Anyway, you can go on.
No, yeah, and I barely was able to catch it. If I didn't have my oldest brother, which he was like 13 years old than me, I wouldn't have ever even experienced it one time if it wasn't for him. So shout out to him, even getting me into Call of Duty. But with that being said, you would do that, and you would do that,
and you'd be rewarded. I mean, the hype was there. It was real every year.
Yeah,
and
right.
The game was that innovative. Yeah.
Right. You're excited. You're doing that every single year, and then after some years go by, you start to realize, I don't know if we're getting older as individuals, we like video games, or we take less interest in video games, or if as an adult life priorities get in the way. But it's like these games don't hit the same, and it's like the games don't hit the same, but also they haven't really been very innovative. And it was like year after year, it's like, okay, I'm gonna buy this Call of Duty one last time, and if it's not hitting, I'm not gonna get the next one. But the next year, it's like you get excited again. I don't know if it's just that nostalgia that is helping sell their next product year after year to their loyal customer base. But it's the same way I view the Apple products. It was like we always had such a good experience in the past with this company, so you always got excited. It was just like your body started to get conditioned to these yearly cycles of them dropping something and being excited for that. But it just got really dull. But I just experienced the same type of behaviors with something like Call of Duty and Apple. It's like there's no more innovation. It's a new product. Everything's new, fresh, new updates. But it's like after 5 years, it's getting a little old without any type of revamp.
Yeah, I think that Call of Duty is an excellent analogy because it also does line up. And much like Apple, at a point, you just run out of carrots and you run out of sticks. And what are you supposed to do? And in the case of a video game, the graphics can't get that much better every year. And then with Call of Duty too, yeah. I mean, in the beginning, you get zombies. That's this new innovative thing. And then zombies evolves more. We get perks. We get gobblegums. We get revelations. You get in multiplayer, we went to jetpacks. All of a sudden, that was like this whole new cool thing with Black Ops 3.
I hated that. I hated that so much. I could not wait.
I liked the jetpacks.
But I thought it was cool. I think it was just because it was gearing off of what I knew as Call of Duty, so I think I was just being a hater. Not that it was a bad game, but
sure. That's valid for sure. But yeah, at a point you just run out of rabbits you can pull out of the hat, and what are you supposed to do? And I think that Call of Duty and Apple both exist kind of in the same capacity, albeit one much smaller than the other, which is that even though the innovation has kind of left, you still continue buying it because you know that it's going to be a solid game. Right. It's normal to you. It's what you're familiar with. And you still think that it at least can hang in the market, and it makes more sense than changing. We're also at the time of year right now where everybody complains about the new 2K game. I think 2K26 just came out. I haven't bought one since like 21. But that is another one that is serious copy-paste every year.
Yeah, I mean, it was a very similar story with FIFA. I know we just seen Madden in the chat. If you want to get to work on Madden, let me know. It's not personal. FIFA, Madden, 2K. No, I'm just kidding. FIFA, Madden, 2K. 2K16 was one that was very popular and hasn't really been.
14 to 17 was like the golden age of that
That's
game.
what I'm saying, and I feel like it's fell off. And when you brought 2K21 up, I was like, oh my gosh, we're so far away from the 2K15, 2K16, 2K17 era. I didn't even realize. But
yeah, man, decade ago, we're getting old. I remember, getting all excited to get a PS4 so I could play, I think, 2K15 on it, something like that. That was when the PS4 was new.
That's insane. Don't even say that, Gus. Don't even say that. Don't even say that, brother. No. As we jump into the market here, we'll do a little quick tour to market. The market was a little boring today. The market started going on an extreme rally towards the end of the day. We're short a little bit of gold. We're up a little bit on that today. We're testing that call strike. Sold to 330, 350. Is anybody else in here trading gold too? Gold's been a wild one, Gus, too. Like, gold is one of those that when it moves, I mean, that thing can move. So going to be patient in that position. We got 38 days left till expiration, though.
Yeah, gold maybe kind of overextended on the year. I mean, gold isn't generally something you trade in favor of momentum too often, but this does feel like a spot where getting short may certainly have carry some weight. I was actually just thinking about that yesterday when I think Dr. Data sent us some cool numbers about gold and gold and silver both being kind of overextended, and I was like, man, I think Errol's going to catch this move.
Yeah, no, I got a little bit of a short position on there, kind of. I think I heard Tom use on the dance floor maybe years ago, whenever the stock price was in between the strike that you sold and the strike that you bought. So I'm going to use that term, kind of on the dance floor with that one right now. Got to be a little bit more patient, let it play out. But, you know, we got a little time on there. I'm going to throw on the RSI, the Relative Strength Index, to show when things are a little bit overbought, a little bit oversold. This isn't something I typically use. I've never been a big fan of the RSI. It was one of those things that I heard about when I was first getting into the market. I would throw it up there just to see, you know, what it was looking like. But I mean, based off the RSI, if it's something that you like to use, we are hella overbought right now. So take that with a grain of salt. But I do have a position on in gold. And we got Google. This is an out-of-the-money call spread. We sold $5 wide. Still going to need a lot of patience on this one. Google absolutely ripping to the upside. Is everything ripping to the upside. NVIDIA tried to cool off a little bit more today. We had sold an out-of-the-money call spread on NVIDIA. We kind of just been chopping around since we put in the highs there. I'm going to be patient on that one, but sitting out of the money on those contracts. We sold a put spread in QQQ. That one's up a little bit more today just because the market's been going on a rally. That one was put on, I think, over the last few days, and then we have a longer-term position on in QQQ, which is an out-of-the-money call spread, and that one's right on the dance floor right now, too. So 38 days, just going to need to be patient in that one, but I'm going to be managing that put spread that I sold on QQQ. Hopefully by tomorrow, maybe before CPI. I think CPI is going to be Thursday of this week. Maybe try and get out before then. And then RKT, one of the risks of the week. I mean, this one's almost at a max loss, and you know we'll just go ahead and glaze over that one. And then SPY, sold an out-of-the-money call spread on SPY. I was able to collect about 274 on that one. 10 days left to expiration. This is one that I can manage a little bit earlier because we are sitting in the money right now. If the market doesn't sell off, this is going to be a good one to get Dr. Jim's thoughts on tomorrow, and I'm going to save it with him just so we can go back and forth on it a little bit. But I'm in a predicament because right now I can manage my losses. I can cut my loss because 10 days left to expiration. We're past the 21 days to expiration, and both of my strikes are sitting in the money. Right, things aren't looking too hot right now for this position. So with that being said, I'm going to ask Dr. Jim tomorrow at least get his thoughts on. What would you do? Would you lean to close the position, redeploy the capital elsewhere, or would you be a little bit patient since we're almost at expiration already, and maybe get a little bit of a buzzer beater move if the market wants to sell off? But nothing too exciting over here, brother. I mean, Apple was one that I'm going to be interested in for the rest of the week, and a couple other names, but that's pretty much what has stood out so far.
Yeah, I think I would be remiss if we did not talk about UNH, which is it continues to recover quite nicely. This was certainly the highlight of my day today. As UNH, I am quite long calls, naked calls, quite long shares. Got me some UNH in the bag, but yeah, continue to make further legs up. There's just more and more big names that keep emerging, disclosing their positions in UNH right now, and this is I think it's a great spot. I think that this could have a ton more upside. I mean, because this is all. UNH has had this outstanding lawsuit forever, and as soon as the DOJ acquits them of that lawsuit, which I think is the most likely outcome at this point, it's dragged on for a long time, or even if they put penalties on them, we can at least put that uncertainty in the past, and I think that would cause much more upside. So any upside movement we get before that decision is made feels like just bonus dollars to me. And beyond that, too, that's the only thing that's actually legitimately, fundamentally keeping the company down right now. I understand their CEO got assassinated, boo-hoo, but it's fundamentally that shouldn't change much. You can appoint a new CEO and things will be okay with the fundamentals of your company. So it's just a very interesting spot to me. I feel like that lawsuit is the only thing that's actually for real, apart from sentiment hanging over this thing's head. And once we clear that lawsuit, whether they beat it or not, I think that this has a lot more upside in the tank.
No, I mean, this is going to be a really exciting one. So we'll wrap back around to it, keep an eye on it. We'll see how UNH digests in the market. I think the Buffett story came out a couple weeks ago. So now we're finally getting some volatility, some movement. Things were a little quiet over the last few weeks, but a really big pop today. That wasn't quiet. Anything else standing out to you before we close for today and we head into the next market day tomorrow?
No, I think that's it. I mean, it was a pretty quiet day for me, despite having numerous positions open. But UNH was the MVP.
We'll see what we get for tomorrow. We got PPI coming tomorrow, and then we got CPI on Thursday. So we'll be aware of that. But we will be back here on Thursday, 4:30 Central Time. Thanks for coming to take the time to hang out with us. Be sure to stay tuned for more segments coming on next. And we'll catch you guys next time. Peace.